Ladies and gentlemen, welcome to the second ever Arcan Capital Fireside Chat with you, Steve O'Brien, founder of Arcan Capital, and Andrew Lorber, partner at Arcan Capital. This is our second ever chat. We got such a positive response to the first chat that there was a full season order. So, like it or not, you're stuck with us for many, many more episodes where we're going to discuss real estate topics and hopefully some other interesting things as well.
Exactly right. And just, as a reminder to everybody, this is a short form medium. So, the concept here is this is a podcast that you can either listen to or watch while you're doing something else, potentially, right? Doing your dishes or driving on your commute or any other task, where you just kind of want to get a snippet of information about what's going on in the real estate world from both, a big picture perspective. And then some of the future episodes will also dive into some of the operational challenges and opportunities that we're seeing. So that's kind of, again, that's the form of this. It's short, it's sweet, it's to the point, and hope you guys enjoy it.
And last time we talked a lot about, I think we did real estate last 20 years, kind of began at the beginning of the 2000s and led all the way up to the changing of the guard of the cycle this last time around. And so I think we want to pick up now at the end of what we talked about at the last time and dig a little bit more into the peak, because I think that will give you a real insight into where we are today.
Exactly right. So I think the idea behind this episode is really to look at, chronologically 2018 to 2023 and viewing that through the lens of that is the end of the cycle and the beginning of the new cycle. And that's really set us up to talk about what's happening in 2025 and what we think is going to happen in 26 and 27. But again, this episode's really kind of focused on that. I'll call it the top of the peak, right? Or the end of the cycle.
So let's start talking about that. What did that look like?
Yeah, so let's talk about that, right? In our last episode, we really walked through the last 20 years, as you mentioned, Steve. Cap rates were consistently coming down, rents were consistently going up. And really, we thought, frankly, in 1819 that things were priced to perfection. We thought that was likely to be the end of the cycle. We thought that there was likely to be some kind of short recession. We had no idea a pandemic was coming, right? But we just were looking at some of the financial data and saying, we think that, we're going to hit a speed bump here.
Well, in the operational, we had trouble buying things.
That's exactly right.
We had trouble, we're used to looking at 100 deals, liking 10 and finding one to buy. But when you're looking at 200, 300 deals and then someone else is paying 5 and 10% more than you were willing to pay for a deal over and over again, that's when you start to ask yourself, is this getting out of control?
Exactly right. And I think it was, right? And we talked about, low interest rate policy coming from the Fed that extended for, more than a decade, driving a lot of this behavior. And whereas we thought that, in 19 things were going to turn, obviously the pandemic hits beginning in 2020. And that, if anything, turbocharges what we'd already been seeing. That's when the Fed dropped interest rates to zero. Obviously the monetary policy is extremely loose. Fiscal policy as well, right? Was loose.
And it's really easy to Monday morning quarterback that right today. But everybody panicked. No one knew what we were dealing with.
That's right.
So at the time, reducing the interest rates to keep the economy going felt like a very prudent decision. It didn't feel like throwing gasoline on a fire. It felt like making sure there was no financial catastrophe.
Well, I mean, to be fair, I would have done the same thing, right? If I were in Jay Powell's position, I would have said, we got to lower rates. We don't know what this looks like. Again, hindsight's 2020. So no, totally agreed. That being said, what we saw in the real estate market was everything was priced to perfection before the debt became really cheap.
Right.
And then afterwards, like I said, it was turbocharged. So we were competing on deals and we weren't even in the ballpark, right? We saw cap rates come down to the 3s for certain product types, which, is unprecedented, at least in the United States. Maybe if you're in Europe, you're used to.
But when you're financing it in the mid 2s, you can justify on paper, you could probably justify some of those prices if you get, and this is going to be a recurring thing, if you continue to get the rent growth, if you continue to keep your expenses in control, and you continue to maintain 2.5%, 3% debt, which we saw at the bottom. And I think, again, hindsight being 2020, it was never reasonable to assume that those things were going to stay that way.
And we didn't, right? So I think this is the point of differentiation between us and some of our competitors, some of whom we respect immensely and have made a lot of money for folks. But from our perspective, we were looking at these trends and saying, there is no way these can continue. We can't underwrite 5 to 10% rent growth per year.
Right.
We can't assume, that interest rates are going to stay in the 2s or 3s. And again, a lot of the folks who were buying these deals were using floating rate, bridge loans, floating over SOFR. SOFR is a secured overnight financing rate. And I can go into that in a later conversation. I'm not going to get too deep into SOFR and what it means.
But it's the rate at which banks can borrow.
It's the rate at which banks lend to each other on an overnight basis, right?
But more importantly for us, it's how you price floating rate debt.
Exactly.
So if SOFR is 0 or LIBOR was 0, which it basically
it dropped down to 5 bips.
5 bips. And you're lending at 250 over, you're able to get a floating rate loan at 2.5%, which we've never seen before. Fair,
yeah.
We'll probably never
and are
see
likely
again.
not to see again in our lifetime. And if we do, then there's a real problem, right?
Yeah.
But to the point, that drove a lot of this buying. So if we saw somebody coming in at bidding 8 to 10% above where we were in a call it mid-force cap deal, they were doing so because they were able to buy it with this incredibly advantageous debt at the time. The problem is a lot of them didn't underwrite an increase in SOFR, an increase in their corresponding debt costs. Right, and so that really started to catch people in 22, into 22, beginning of 23, as rates begin to come up, right? And really 23 is the year where it's kind of, that was the turning point. That was the inflection point.
And so we talk about the peak, 19 to 22, a 3-year peak.
That's right.
So it's funny, in the late teens amongst real estate people, we started talking about what inning are we in of the cycle, meaning real estate's a very cyclical business. There are good times, there are bad times. Knowing the difference between the two can mean the difference between making money and not. And we think the 9th inning probably lasted 3 or 4 innings.
I think we went to extra innings.
Yeah, we went to extra innings.
Right?
That's a great idea. Yeah. So everyone was talking about how we're in the 9th inning. We had a 6-month break in 20 when we were all panicked.
Yeah.
And then we had 2 more years of it's the end of the cycle.
Is that a weather delay?
There you go. Yeah. It's the tarp out. The tarp was out. People were sliding across the field.
Yeah.
And that, it was difficult to see when you're living it, but in retrospect, boy, you could have seen it coming. And so with that, I want to jump into, okay, so what ended it? What happened?
I think that's a great question. Okay, so again, I'm going to go back to my point about floating rate debt. Right, that was one of the key drivers, was interest rates increasing. SOFR today is in the low 4s. So if you think about that, where SOFR is 5 basis points, so 0.05%, and you get all the way up to 4.5%, 5% is kind of where it got to, right? Actually got above I think it was about 5.5% at the peak. You're talking about an interest cost. If I'm just going to use the 200 basis points over, right? It was actually a little higher than that, but that's just easy, right? So if you're paying 2% for your loan, and now you're all of a sudden paying 8% for your loan, you didn't underwrite that, and that is going to wreck your deal, and it's wrecked a lot of people's deals, right? So that was one of the things that was, and I think, a major contributor to the end. So the availability of equity capital and debt capital both shrank, not to unprecedented degrees, but they certainly shrank.
Too much new construction.
There was way too much new construction, and in some markets it warranted it, but in a lot of markets, I can think Nashville in particular got out over its skis. Now Nashville's come back a bit. But Nashville certainly got out of its skis. Atlanta, we built
Midtown,
how many units? Midtown.
Buckhead.
How many units did we build in Atlanta in Midtown?
I mean, I just know that at one point we had 35,000 units waiting to deliver.
That's right.
And at a time when you probably didn't want to have any delivery, you wanted to wait and see what was going on.
So what's happened to rents in Atlanta, in Midtown and Buckhead?
And they've gone down.
They've gone down.
And so to recap, the other one I think is everyone is experiencing, which is inflation.
Exactly.
Expense inflation. So I think if we wanted to solidify the 3 things that we think happened to the market, they are interest rates began to increase. You had too much new construction and expense inflation.
Right. And again, the new construction drove down rents.
Right.
And rent growth was flat at best through most markets.
And anyone who's run a business can tell you probably don't even need to run a business to know that if your income's going down and your expenses are going up, that is not a recipe for success.
That's exactly right.
And the market was doing that. That is, doesn't matter which operator, it doesn't matter which investor, the market got together and as a reaction to what the previous few years had been and had changed some things. So I think we definitely want to dig into more of the interest rate increase, which you kind of started to talk about a little bit, but there are a lot of effects to that. When the interest rate goes from 2 to 3% to 7 to 8%, you can't pay it. But even more importantly, that I want you to dig into is, okay, let's say I can afford it and I have a bunch of reserves and I can afford it. I still can lose my deal because I took out 80% loan and I've got to refinance this
Exactly.
thing. But
so the refinancing risk is real, right?
Yeah.
And I think that has largely come to the fore in 25 and will again in 26, where there's this, people have been talking about this wall of maturities for a while, right? And I think, look, a lot of lenders have kicked the can down the road. I want to be mindful of this. I want to make sure we stay in our bracket here, right? That's a little bit more of what's happened, more currently. But to your point, what has happened, the market really became illiquid in 23, largely because you had a lot of people who bought assets in 2020 and 2021, right, on 3 to 5 year floating rate debt.
And that's important. The floating rate debt terms are always shorter, not always, but they are generally shorter than the fixed rate debt. You're normally seeing 3 years, so 36 month with 2 1-year extensions for floating rate debt.
Right. So that's where the wall of maturity comes in. But at the same time, if my debt costs have increased as an acquirer, which we have been in this period really since I guess 23. But if your debt costs have increased, therefore you can only accept a certain cap rate, right? So cap rates naturally also have to increase if you're going to meet the market. Now, I think there are a lot of folks in this period who are sellers, who are unwilling to meet the market because they realize that the price of their asset had dropped by 20% roughly. Certain, obviously, that really depends on location and asset type. But I think as a broad measure, 20% is about accurate. So all of a sudden, if you have an asset that's worth 20% less than what you paid for it, you're unlikely to try and exit unless you're forced to do so.
That's an important point. Interest rates don't just go up on you. They go up on everybody. So not only did it become more expensive to go get interest for you, it did for the person you're trying to sell the deal to as well. So when that person's looking at it, he's saying, I got to pay 7% interest. I can't pay 3 anymore. And whether we like to admit it or not, interest has a huge effect on profitability, on yields. And in fact, one of the things we've talked about recently is negative leverage, meaning your interest rate is above your cap rate. Exactly. And you can only do that in a massive rent increase environment.
That's right. So you've run into this kind of interesting problem at the end of 23, which is you can't sell the asset for what you paid for it even 2 years prior, right?
But you need to refinance.
But you know that you're going to have to refinance it within the next 12 to 24 months, right? So and operational costs, to our point, have increased because of just general inflation.
It's not worth what you paid for it. So if you've got a debt that's coming to maturity and your asset's not worth what you're paying for it, you really have 2 choices. You can sell it and lose money. Mm-hmm. You can refinance and put more capital in the deal. And that's about it.
Right? So in 23, you're looking at this and saying, okay, I'm really hopeful that I can ride it out and interest rates are going to come back down again.
And that's what we're seeing a lot of.
And that's what we're seeing a lot of. And that was the hope in 23. Right. Stay alive till 25 was the mantra at the time. Yeah. Now it's the end of 25, and it's I don't know, keep it kicking till 27. I don't even know.
Yeah.
But nevertheless, at the time you started to see. The market in 23 from a transaction volume standpoint just cratered. Right. Now it didn't hit historic lows, so I want to be careful about being too hyperbolic here. But at the same time, if you look at the transaction volume from 2020 through 2022, it was massive. And it really faced a big cliff in 23 because, again, buyers like us were requiring premiums because of the debt costs, the interest rates. And then, a lot of sellers weren't willing to meet the market because they didn't want to realize 20% loss on their asset.
And that's what's really fascinating is it wasn't a capital problem. The last time around, there was no capital to buy the deals. And the prices just kept falling because no one had the money. This time there was plenty of money, but there were no willing sellers.
Exactly.
No one wanted to sell and take the loss because you'd almost say it wasn't bad enough, right? The GFC was so bad, people were just offloading things and getting rid of it at a certain point. But this, I've lost 10% of value. I've lost 20% of value. But if I could just hang on, I think it will come back, and we're still experiencing that today.
That's also the lesson of GFC, right? Had people hung on, they would have made a lot of money.
Hang on. And I think we're seeing the behavior there. I just need to hang on, which is probably not untrue.
No.
It's just, can you do it? So that's interest rates increasing. We also have the effect of new construction.
That's right.
Which is a very basic supply and demand, right? If you build too many new things and there's too much of it available, you're not going to be able to increase the price of those things.
That's exactly right. Basic laws of economics, right?
Right.
So to your point, there was a wave of new construction in this period, which frankly, there should have been, I think, largely, right?
Agreed.
We all know that there aren't enough homes in this country.
Right.
And I include, obviously, apartment homes are a massive piece of that.
Well, everybody's heard of the affordability and the housing crisis.
Exactly right. So, in our view, how do you work your way out of an affordability crisis? Well, you need more product because You need to flood the market with demand to lower. I'm sorry, flood the market with supply to lower demand costs. So what we've experienced across our properties as well is, as correspondingly, there was no rent growth. Right. So rent growth slows. That's going to put a lot of deals into trouble. Again, those especially who have underwritten 5 to 10% increase per year, because that's what we saw in the pandemic. To be fair,
but in Atlanta, you've had 3 straight years almost now of negative rent growth, which means all of the increases from the pandemic weren't real because they've reversed themselves over the next couple of years. So that one's actually pretty simple, as is the next one, which is inflation. We've all experienced it.
Yeah.
Prices for goods and services at apartments go up the same way eggs do. Your payroll is more expensive, but your payroll being more expensive isn't just your people working on the property, it's the people working for your vendors. So then their prices go up in addition to the cost of wood, the cost of metal, the cost of everything, right? We believe that insurance companies were asleep at the switch.
I was going to say, to me, the insurance costs of all of them have been, I think, the most jarring in some ways. To your point, insurance companies were asleep at the switch. Insurance premiums had not increased in years.
And they should have, because think about it this way, right? If I'm paying $100 to insure something that's worth $1 million, if it increases to be worth $2 million, I should pay $200 for it.
Right.
In theory, my premium should go up.
Your premium should increase. My asset increases. Now, they didn't. Is it a correlation of one? I don't know.
No, we don't know the correlation, but they didn't go up almost at all. And then it's almost as if the insurance companies woke up one day in 2022 and said, "Oh man, we have to increase our premiums."
Exactly. My risk exposure is much greater than I thought it was, and they did, right?
And that's one of your largest expenses, right?
It's easily one of your largest expenses.
You have water. You have real estate taxes, which also went up because real estate taxes also increase with the value of your asset.
Exactly.
So taxes and insurance both went up, and payroll is another one of your major expenses. So you're not talking about a 5% increase in wood and, we're only buying some wood. It is across the board. Your expenses started to go up at the exact same time that you lost your rent growth. So you are legitimately going backwards on your P&L, your profit and loss statement, your income statement.
That's right.
So
and to be very candid, Steve, on some of our properties, we went backwards.
Oh, of course.
Right.
And that's actually one of the other things that we want to talk about as a part of the expense inflation is what is the combined effect with this and how do you handle it? Well, the combined effect is what looked good before doesn't look good now.
That's right.
You're making less money than you were before. Not just not making more, which, by the way, is required for all of our investments. You need 2 things to happen for investments to be very successful. One is you have to increase your profit, okay? The other is the sales environment has to stay just as good or get better. What happened in the 2000 teens, is both. Your revenues and profit went up and your cap rate started falling. So it was a double whammy of profits in a good direction. And it reversed, both of those things reversed course starting in about 2022.
Exactly right. Yeah. End of 22, beginning of 23, which again is why I continuously refer to 23 as the inflection point in this market. Right. Because you had this environment where profitability was declining, cap rates were increasing, and which makes every investment in the multifamily space less attractive.
And your cap rate, and we haven't talked about this specifically, but cap rate is a reference that we make to your net operating income or your profit over the purchase price of your property. So if your cap rate is going down, your values are going up. If your cap rate is going up, your values are going down. And cap rates, they don't correlate directly to interest rates, but
it's not a correlation of one, right? But
it means it's a lot of different
correlated.
If there's, again, the more capital chasing deals are likely going to drive cap rates down because everybody's looking for a return. Yield requirements, how much profit I want to make. But interest rates have a pretty high correlation to cap rates. It's really hard to pay a cap rate below your interest rate for any meaningful period of time.
I think I would make the argument that in today's market, the interest rates are driving the market more than any other factor right now, right? There's plenty of liquidity from an equity perspective. There's a lot of capital out there waiting to be deployed, right? So I don't think it's an equity question.
Yeah, you very rarely buy a $20 million asset with cash.
Exactly right.
You take out some level of debt to increase your returns.
Take out. Look, that's the beauty of real estate is that it's levered, right? That creates a lot of opportunities and advantages. But again, I think what's driving the market right now is largely interest rate costs.
And so let's talk about, I think we've gotten to the effect of all of this. We've walked through the beginning to the end. The most important part is, okay, this is probably going to happen again one day. How do you avoid this? How did we avoid getting into trouble? As you mentioned before, that we have assets that are not performing as well as they were previously, which is very true, but we have not had to give any assets back. Thankfully, we've not had to have any capital calls. And I think it's important to talk about how do you avoid that? It is not because we saw the pandemic coming. It is not because we are, have a crystal ball we looked into and it said, hey, start doing X, Y, and Z. But we do things somewhat differently here at Arcan. And I think
Right.
it's
Well,
worth
and we
talking
refer
about.
to it as block and tackle, right?
Right.
And I think that's kind of the key to our philosophy, which is real estate. A somewhat wise man once told me, you're in for 2 cycles or 20.
Right.
Okay. And he's right. And I think if you are in for 20, you recognize that multifamily in particular is a long-term strategy. Right. You want to make money in this? Yes, you can gamble. I can go to Vegas to gamble too. Okay. But if you want to make money in commercial real estate, you need to be in for the long haul. And that means most likely, unless you're going through a major rehab on a property, you're talking about moderately leveraged fixed rate debt.
Right. So let's talk about what that is. 50 to 75%.
Mm-hmm.
Is that moderate?
Yeah, you mean LTV?
LTV on the loan, which is the percentage of that loan to your purchase price.
Right, exactly right. The total capital stack.
Now, these floating rate debt, you can get 80 to 85%, and then they lend you all your capital. So if your value didn't go up, you could be talking at 90% leverage on that deal, which makes it, if it goes well, you make a lot more money on a percentage-wise. Your IRRs are much higher. Your internal rate of returns are higher. But I think we forgot for a little while that as your LTV goes up, so does your risk. And that's depending on what your goals are. We use floating rate debt too, but we started retiring our floating rate debt during the pandemic. We saw the pandemic as a warning. Hey, be careful. Interest rates are probably going to start going up here soon. You can take this massive risk, or you can start to de-lever your portfolio, fix all of your interest rates, and move away from the floating rate debt. Because we did think interest rates were headed up.
No, we did. We absolutely did.
They had to.
Yeah. Well, I mean, that's the thing is, if your interest rates are at 0, they can only go one direction. Right. So, in that case, what we did was we saw how low interest rates were, so we decided to fix everything, which I think was the prudent move. Obviously, it got us through this period with no financing issues whatsoever in our portfolio, no capital costs, because one of our biggest costs, again, interest, was fixed. Right. So we knew exactly what it was going to be.
20 grand a month, 30 grand a month.
Very easy to budget for that, right?
Yeah.
When you have a floating rate interest, security, I mean, it can go up and down. It's unpredictable, especially because it typically resets every quarter. Right. That, and if your interest rate again goes from 2 to 8, that's really hard to budget for, and that can kill a deal very quickly.
I think the other thing that I'll throw in there too is better operations. And that is what one of the things Arcan takes a lot of pride in is we run all of our own assets internally. So we hire the property manager, we hire the maintenance team, and we believe that gives us a little bit more control over what's happening on site.
Not just that, Steve. How many checks do you sign a week?
All of them.
All of them. Right.
So every dollar that leaves here, we're in control of. And that can help in a great market. Honestly, I'm not sure how much it does for you. You probably outperform a little bit. But in a bad market, it can be very helpful because you have instant, immediate feedback and control over your operation.
Well, I think we should be honest with ourselves, right? We're not the 90% floating rate debt shop.
Right.
In a booming market, they will outperform us. I think we need to be honest about that.
Yeah, that's fair.
Okay, they will outperform us because we're not willing to tolerate that level of risk because we don't think it's prudent and we don't think that the risk reward balance is there. For us, we want to mitigate risk to some point, which is why we fixed all of our debt again. Right,
we are sacrificing some profit to limit the chance of ever having to lose an asset or lose investor money.
We're sacrificing the possibility of
the possibility
right?
of profit.
And I think that's the point.
Yeah. And if you time it perfectly, it doesn't matter anyway. But it's really hard to time these things.
It is.
Which is something we're going to talk about next time because we want to stay short and sweet on these as much as we can. So the next time I think we're going to transition to the very recent past and start talking about what it looks like today, where we think it's going today, and how much longer are we going to be here.
Exactly right. So now I think we've set the table. Let's enjoy the meal in the next episode.
Perfect. Thanks again for joining us in our second ever Arcan Fireside Chat.